Hello, everybody. Welcome to Clef Investments. Last week, we discussed the ETF with managed floor, and that's the kind of ETF that has less risk and less return. So there are several types of this kind of ETFs. They're often called buffered ETFs, and they have some different characteristics. Let's compare them this time. So these ETFs track a stock index, but they reduce the risk of the stock index, and also they give you less return, which might be a good trade-off, depends on your situation. And to get less risk, they often have a target protection range. Like they give you two numbers. Basically, when the stock market is between these two numbers, the ETF's value doesn't change. For example, if the two numbers are between 0% and minus 100%, that means the ETF's value never go down. No matter how much the tracking index drops, the ETF's value doesn't drop. So it gives you the complete protection. Or some other type of ETF give you between 0 and minus 10% of protection. That means if the market stops dropping in the first 10%, your ETF doesn't drop. So for example, if market goes down by 3%, the ETF doesn't go down. But if the market goes down by a lot, like 23%, then the ETF only stops dropping for the first 10% and then starts dropping with the market again. So the ETF would lose about 13%, which is also not good. Or they could protect a range, for example, between minus 5% and minus 10%. So if the market drops less than 5%, then ETF drops together with the market. But if the market drops between 5 and 10%, the ETF stays at 5%. And finally, if the market goes down by a lot, like 23%, ETF is down by 18%, which is 5% less because the size of the buffer is 5%. And whenever you have less risks, it takes money to buy some put or put spreads to protect the ETF. And as a result, the ETF often limit the upside potential. So one type of limitation is they provide a cap. So for example, if they say the cap is 10%, that means if the market goes up, the ETF follows until it reaches the 10% cap. So for example, if market goes up by 17%, ETF would go up by 10%. If market goes up by less than 10%, such as 8%, ETF would also go up by 8%. Another type of limitation is you only get a portion of the upside potential. So for example, if the ETF has 70% upside potential, then that means the percentage of the market going up times 70% is how much the ETF would go up. If the market goes up by 20%, ETF would go up by 14%. Okay, so there are basically three types of buffered ETF. One is called the max buffer ETF. It has a target protection between 0% and minus 100%, and it has a relatively low profit cap. This profit cap often depends on the interest rate. If the federal interest rate is high, then you get a higher profit cap. Otherwise, the cap is lower. So for example, for the MMAX ETF, it started on March 2025, and it has a cap of 7.61%. And then for the recent one, the December 2026, its cap has dropped to 6.3% because the federal rate has dropped since then. And if you buy and hold the max buffer ETF, on that month, when they renew that ETF, the cap would depend on the interest rate at that time. So on a low interest environment, the buffered ETF may not be very friendly. There's also the targeted buffer ETF, which has a protection less than 100%, and then a much higher profit cap. So for example, it could protect the first 5%, 10%, or between 5% and 10%. And because the protection is much less, the cap on the upside is also much higher than the max buffer ETF. So for example, the BAPR buffered ETF, it protects the first 9% of the drop. And then after that, it no longer protects you. But its camp is 16.12%, which is more than double of the camp of the max buffer ETF. And another type is called the managed floor ETF, where it protects between 10% and 100%. So it means the ETF will drop with the index, but only up to 10%. Beyond that, it reach a floor and never drop again. And the cost of doing that is it can only get about 70% of the upside potential. So it grows slower than the index is tracking. The example is the QFLR, SFLR. FLR in the symbol means floor. Okay, so if you look at the profit loss picture of these three types of the ETFs, you can see in these three pictures. The x-axis is the index price from lower to higher, and the y-axis is a profit or loss. And the zero line means you don't have profit nor loss. So the left side is max buffer. You can see the picture stops at zero and only goes up, but it goes up to a small cap. In the picture, I draw 10%, but in reality, it may only be 6%. And for the targeted buffer, the picture in the middle, you can see that it stops the loss in the first 9%, and then it starts dropping again. And then on the upside, it has a much higher cap. On the right side is a managed floor, where it drops together with the index on the first 10% and then stays flat after that. And if stock index goes up, the speed of the managed floor ETF goes up, but at a slower speed. Okay, so three ETFs, they have their different trade-offs. And which one I would recommend? I think the one we want to avoid is the one in the middle, the targeted buffer that doesn't give you the 100% protection. Why is that? Because stock market can have very high volatility, and they follow a fat tail distribution, not a normal distribution. That means extreme price movement to the upside or downside can happen, and it can happen at a much higher probability than predicted by normal distribution. And it can be caused by, we call it a black swan event. And then when that happens, if it happens on the downside, the stock can go down by a lot. And if you only reduce the loss by 9%, it's not enough. But if there's a good news and the stock goes up by a very high amount, the ETF will be capped by its cap. That means it catch most of the downside, but lose the potential of the upside, which is something we always want to avoid. The picture on the left, max buffer, it gives you complete protection, but the return is very low, especially when the interest rate is very low. So if you only plan to hold the money for a short period of time, and you need to use the money afterwards, then the max buffer could be a good use case. But in general, I think the concept of managed floor ETF is much better because it has a fixed floor, max 10% loss, and its upside potential is unlimited. You lose 30% of the potential, but you get most of the upside potential. If there's some kind of very good news, the stock goes up by a very big amount, you can still participate in 70% of it. So personally, I never bought any of these ETFs, but based on their risk and profit profile, I believe the managed floor, the one on the right, is the best. And the one in the middle, the targeted buffer, is the worst that we should always avoid. Okay, that's all for today. Thank you for watching. See you next time.